You're in the market for a second home and looking to sell your first home, stop. I'm going to explain to you how you can build wealth and save massively on tax savings using your existing home. Hi, my name is Zachary Jensen. I'm the managing partner here at TaxWise, where we're taking high income earners and business owners and giving them tax strategies so they can build wealth faster. In today's video, we're going to go over how retaining your old house and utilizing this strategy in this video can save you massively on taxes and help you build wealth in the long run. So many people go to buy a new primary home, they move in and they flip the old place into a rental. Well, in this video, we're going to go over how you can flip the old place into a short-term rental first, get the material participation, run a cost segregation study, accelerate the depreciation, and use those losses to generate tens of thousands of dollars against your W-2 income, and then put the property into a long-term rental to make it simpler for operations long-term, but you get to keep all the tax savings up front you banked in the first year. Here's how it works. Step number one, we buy a house. Step number two, we convert that house into a short-term rental. The moment your old home is available for rent and actually listed, it's called placed in service as a rental property. Keep personal use to zero or de minimis to avoid vacation home limits under Section 280A. Generally, you don't want to exceed greater than 14 days or 10% of the rental stays for this strategy to work. To qualify your short-term rental activity as non-passive, aim for average guest stays of 7 days or less to meet the material participation requirements. If you don't material participate, the active losses that we're going for will actually be considered passive, and you can't offset your W-2 income or business income. So the participation is the linchpin and most important piece of this. Step number two, what we're going to do is run a cost segregation study in the first year. This cost seg breaks the property into two components, land and 27 and a half year structural components, like walls, roofs, etc., and short life personal property like appliances, carpet, etc. The short life buckets are eligible for accelerated depreciation, and portions of those may qualify for even what's called bonus depreciation at whatever the current year bonus percentage is. This year, since we're filming this video in 2025, Big Beautiful Bill has that at 100% and it will be for the foreseeable future. So this results in large first-year deductions without spending any cash because you already own the asset. Then we make those losses count. So combining step one and step two, if your short-term rental is not passive and you meet the material participation test, your depreciation loss isn't trapped by the passive activity limits. That means the losses can offset your ordinary income. So if we generate, let's say, $50,000 or $500,000 depreciation, whatever it is, let's say your W-2 for this example is $200,000 and we generate $100,000 depreciation. Well, on paper now, you're going to have that $100,000 loss against your active income. So you're not paying taxes on $200,000 anymore, you're paying it on just $100,000, and that's saving you tens of thousands of dollars in taxes in 1 year. You, of course, need to track your hours meticulously, avoid outsourcing that so you can meet the material participation tests. Also, minimize personal stays in the property, so make sure you don't go back and stay in it. And if marrying filing jointly, you and your spouse can count hours collectively towards that participation. Step number four is actually timing and documenting everything and then doing the 1 year pivot. So you only need the short-term classification and material participation in the first year to take the big deductions. That's what the move is. So we convert it to a short-term rental, place it in service, run that cost seg, book the loss in that year, and then in the following year, you can convert it to a long-term rental for simpler management or keep it as a short-term rental. A lot of our clients test out, hey, can I run this as a short-term rental? And if it doesn't make any money, they know in the back of their minds, well, they can still turn that to a long-term rental. It's all going to be good. And then you can continue the regular straight line depreciation going forward. So the accelerated depreciation you already claimed stays claimed. And then, of course, we want to keep a clean paper trail. So list dates, calendar stays, etc., hours logged, invoices, and of course, the cost seg report itself. Step number five, understand the downstream tax mechanics. So depreciation reduces your basis and allows you to shelter cash flow. If and when you sell, you'll have depreciation recapture, which is a 1245 recapture as it's known, or personal property components that were bonus depreciated will basically have you pay that depreciation back. So that's something that's somewhat of a downside for people trying to flip, but this is not something that you want to do if you're looking to get in and out. This is something you want to do for if you're in the bucket where, hey, I'm looking to build long-term wealth. I'm looking to hold this property for a long time anyways, and I'm not looking to sell for 5 to 7 years. That's really the type of person we want to do this strategy for. This allows you to speed up your wealth building now and simplify things later. So, this play turns your old home into an engine to capture large paper losses year one, reduce your current year taxes well over five figures in most cases, and then downshift to an LTR, long term rental, in years two plus for steady, low touch and low maintenance income. And then the tax savings you freed up then can be redeployed into the next down payment, reserves, improvements, right? Things that make you or allow you to build wealth faster. So over time, you're stacking equity growth from amortization, appreciation, tax advantage cash flow, and the optionality to exit. You can always 1031 as well. So there's a lot of value to the strategy. You can get the thrill of the first year tax win without being committed to the strategy forever. So you can accelerate now, cruise later, and compound much faster. So if you're interested in a strategy like this or want something more custom to your situation, please reach out to me. Our contact information is in the description below. Thanks so much for watching and have a great day.